Before we begin, a quick disclaimer. Nothing on this channel is financial advice. I'm not a financial advisor, and this content is for educational and informational purposes only. I'm sharing how I think about markets, risk, and capital from a macro and risk management perspective. Any decisions you make are your responsibility. All investing involves risk. This channel is about structure and signals, not predictions. In our strategy, we use a 5-phase cycle framework. We're not predicting headlines, we're tracking signals, sequencing risk, and protecting optionality. Here's the tension. The market is acting strong, but some of the most economically sensitive indicators are rolling over hard. That gap is the part we don't ignore. We're reviewing Bravo's research and their video. In 6 months, it's all over. They focus on cyclical signals like truck sales and housing. Go watch the original for full detail. Our job is mapping it into our strategy. Quick disclaimer. This is not financial advice. This is educational commentary about macro signals and risk management. The claim is simple. Truck sales tend to peak before the stock market peaks. And right now, truck sales are falling fast while stocks are near highs. Historically, that setup hasn't been common. Heavy trucks are like the arteries of the economy. When goods flow accelerates, demand for trucks rises. When activity slows, truck demand drops quickly. The video argues the market isn't the first mover. Cyclicals roll over first. Then the index peak comes later, often months later. They pair truck sales with housing sales. Housing is a big-ticket decision and a confidence signal. When housing freezes, broader spending tends to cool later. Here's the chain we care about. Cyclical demand weakens. Revenues soften, profits get pressured, then hiring slows, layoffs rise, consumer credit worsens, risk assets reprice. The key nuance: markets can ignore real economy weakness for a while, especially when earnings are insulated and liquidity stays supportive. That's phase 1 behavior in our framework. The video highlights reasons profits can stay elevated: cost discipline, global revenue exposure, and the AI capex boom. And inflation optics can lift nominal prices even if real growth is flat. In our strategy, this looks like phase 1 fragility. The real economy is signaling deceleration, but the index can still levitate until labor and credit confirm. Scenario A. This time is different. Profits hold, the market grinds higher. Scenario B. The classic pattern. Profits roll, labor follows, and risk reprices. Our job isn't picking a story. It's preparing sequences for both. We'd watch for labor weakening to broaden. We'd watch credit spreads to widen and lending standards to tighten. And we'd watch volatility shift from calm to sticky. If housing stabilizes broadly and sales re-accelerate, that matters. If truck sales bottom and recover, that matters. And if breadth improves while credit stays calm, phase 1 can persist longer. This raises the value of optionality. It tightens our exit discipline on any melt-up exposure, and it increases our readiness for ladder-based deployment if stress confirms. We don't go all in on a single indicator. We don't confuse a chart with confirmation of a forced liquidity event, and we don't abandon process just because prices are high. Watch truck sales and housing prints for follow-through. Watch labor for confirmation, not one-off headlines. Watch credit and funding conditions for the mechanical stress signals. And watch breadth. Leaders rolling over is often the early tell. We don't need to be early, we just can't afford to be late.